Hello, everyone. Today, we're diving into a topic that is often the make or break factor for anyone, the loan. If you want to move from owning one home to building a multi-property portfolio, you have to understand that finance is your fuel. If you run out of fuel, or if you use the wrong kind of fuel for your specific engine, you're going to get stuck. Many people start their journey by one or two properties and then suddenly find themselves hitting a wall. They're told by their bank, "Sorry, we can't lend you anymore." Usually, that's not because they aren't rich enough. It's because they didn't understand the diversity of the Australian banking system. Most people only know the big four. But if you ignore the smaller banks and the non-bank lenders, you are essentially trying to win a race with one hand tied behind your back. Today, we're going to break down the three tiers of the Australian lending landscape, explain how the money actually flows from the central bank to your mortgage, and help you decide which institution fits your specific investment goals. The foundation: where does the money come from? Before we talk about the banks you see on High Street, we need to understand the bank for banks. That is the Reserve Bank of Australia, or the RBA. The RBA is our nation's central bank, and it plays a massive role in your daily life, even if you never walk into one of their offices. In simple terms, many Australian banks actually borrow money from the RBA. They then take that money and lend it to you, the everyday Australian, or to businesses and even the government to fund infrastructure projects. However, the RBA isn't the only source. Banks are essentially money retailers. They buy money at a wholesale price and sell it to you at a retail price, which means your interest rate. They get this money from three main places. The RBA, the central source. Overseas markets. They borrow from international investors and financial channels. This is why the big players are called ADIs, or authorized deposit-taking institutions. When you put your savings into a high-interest account or a term deposit, the bank uses that liquidity to fund someone else's mortgage. Understanding this helps you see that not all lenders are created equal. Some have more cheap money than others, and some have more flexible rules about who they can give that money to. Tier 1. The giants, the big four. Let's start with the heavy hitters. In Australia, the big four dominate the landscape. These banks are some of the most profitable in the world, and they hold the lion's share of the Australian mortgage market. However, interestingly, their market share is actually dropping every year as more people realize there are better options elsewhere. To keep their grip on the market, these big banks often own smaller brands that you might not even realize are connected to them. Let's look at who they are. Commonwealth Bank, the undisputed number one by market share. They also own brands like Aussie Home Loans and Bankwest. Westpac, the second largest. They have a massive umbrella including St. George, Bank of Melbourne, and Bank SA. National Australia Bank. They've made a huge push into the digital space, notably owning the online bank UBank. ANZ, the fourth pillar of the giants. Why choose a big bank? The main reason people flock to the big four is convenience and service. If you're someone who likes to walk into a physical branch and talk to a human being, the big four are your best bet because they have the most extensive branch networks. They also invest billions into their technology, meaning their banking apps and online platforms are usually the most advanced and user-friendly. They offer one-stop shop services. They want to hook you in with a mortgage, then give you a credit card, then your car insurance, and then your superannuation. This bundling is designed to make it very hard for you to leave. In terms of pricing, their interest rates are usually middle of the road. They aren't the cheapest, but they aren't the most expensive either. Instead of offering the lowest rates, they often use cashback offers, giving you $2,000 or $3,000 to switch to lure in new customers. The major downside, the conservative trap. Here is the catch. Because these banks are so large, they're under the most intense scrutiny from government regulators. This means their lending criteria are very conservative and cautious. If you apply for a loan at a Big Four bank, you might find that the amount they're willing to lend you is significantly lower than what a smaller bank might offer. If you're trying to build an investment portfolio and need to maximize your borrowing power, the Big Four might actually be the ones to hold you back later in your journey. Tier 2. The challengers, second-tier banks, and credit unions. Now we move to the second tier. These are household names, but they aren't the big four. We're talking about banks like Macquarie Bank, ING, Suncorp, Bank of Queensland, and various credit unions. This is where things get interesting for investors. The primary reason people switch to these lenders is borrowing capacity, more human underwriting. While the Big Four often treat you like a number in an algorithm, second-tier banks can be more human and flexible. In the same income situation, a second-tier bank might calculate your expenses differently or be more generous when looking at your rental income. For example, if you're buying an investment property, a Big Four bank might only count 75% of the rent toward your income to play it safe. A second-tier bank might count 80% or 90%. That small difference can mean the difference between getting the loan and being rejected. Sometimes, you only need an extra $50,000 or $80,000 to clinch a deal, and these are the banks that will get you there. Flexibility for unique incomes. This tier is also a lifesaver if your income is non-standard. If you work casual shifts, part-time, or have multiple income streams, the Big Four might put you in the too hard basket. Second-tier banks, including some of the subsidiaries owned by the big banks, are often much more lenient and willing to work with these types of income. Tier 3, the specialists, online lenders, and non-bank lenders. Finally, we have the third tier, which we can split into two categories: online banks and non-bank lenders. 1. The online lenders, the rate chasers. Brands like Athena Home Loans or Ubank fall here. The pro, they almost always have the lowest interest rates in the market. Because they don't have physical branches or thousands of staff to pay, they pass those savings on to you. The con, their service is entirely digital or over the phone. Furthermore, they're usually only interested in simple cases. If you have a steady PAYG job and a high deposit, they will love you. But their lending criteria are usually not very flexible. They don't do complicated. 2. The non-bank lenders, the capacity kings. Then we have companies like First Mac, Liberty Financial, La Trobe Financial, and Pepper Money. These are not banks. They don't take deposits. Instead, they raise money from private investors and international markets to lend out. The pro, they're the most flexible lenders in Australia. They can often waive certain strict requirements that the big banks are forced to follow. If everyone else says no, these guys often say yes. They generally offer the highest borrowing amounts of any institution. The con, because their money is more expensive for them to source, they will charge you a higher interest rate. If you're at the point where your portfolio is large and the traditional banks won't touch you, these non-bank lenders are the secret weapon that keeps your investment journey moving forward. Just be careful. You need to make sure your cash flow can handle the higher rates. Stop chasing the lowest rate. The biggest mistake I see investors make is only looking at the interest rate. Yes, a low rate is nice, but if a bank offers you a 5.5% rate, but only lends you $500,000 and you need $600,000 to buy the property you want, that low rate is useless. Instead, ask yourself, what is my goal? Do I need an offset account to save on tax? Do I need interest-only payments to help with cash flow? Do I need to maximize my borrowing power so I can buy my next property sooner? The right bank is the one that helps you reach your specific goal, not just the one with the flashiest TV commercial. Conclusion and your next steps. To wrap things up, the Australian mortgage market is much bigger than just the 4 logos you see at the local shopping center. Understanding the tiers, from the RBA down to the non-bank lenders, is what separates the amateur buyer from the professional investor. For most people listening, the best advice I can give is this: don't go it alone. Unless you want to spend hundreds of hours researching the fine print of 50 different lenders, you should find an experienced mortgage broker. A good broker has access to all these tiers. They can look at your income, your goals, and your current properties, and then tell you exactly which bank will give you the best deal and the most money. They're the bridge between you and your investment goals. Next step, would you like me to create a checklist of questions you should ask a mortgage broker during your first meeting to ensure they're the right fit for your investment strategy? Thanks for listening, and I'll see you next time.